All right. And my last video I think I'm going to make this weekend is going to be the earnings calendar. So how does this work? Well, conventional advice on this is that it's long vega, that you want volatility to go up because the Greeks are long vega. But it's not exactly true in practice. It's actually short vega in practice. And so what you're looking to do is capture the post earnings, the infamous IV crush, right? So here I got up the tool for earnings on TOS Thinkorswim. Um, and so how I like to do these trades, I like to enter in between like 2 and 3:30 p.m. Eastern, hour or two before the market closes, to try and peg the strike. The before earnings. So if like they report after the bell that day, you go in 2 or 3 o'clock that day. If they report in the morning, you go in 2 or 3 o'clock the day before, et cetera, et cetera. Right? You want to be right before. You don't want any delta or theta exposure during the day. There's no point because you're trying to pin the strike, as you're going to see. The max profit comes from the strike. So let's just say CoreWeave, which is CoreWeave is probably going to be actually something that I do play this week. Probably we'll see. We're going to build this trade here in our little analyze things here. So we type in CoreWeave, look at the options chain, see if it's candidate, and it is a candidate. And as you can see, this is what you want to see. You want to see high ass IV in the weekly. Well, I mean, this is the monthly, but usually it's the weekly. You want to see high IV, and then you want to see this. You want to see the old vol, the old fucking skew slash smile. So what you want to see. So what do? Come in here and you pick a strike. This is why I usually wait until the like the market's about to close, because max profit, you need to pin the strike. Okay, so let's say we're gonna go for 130 on CoreWeave. Pretend it's about to release and it's trading at 129.55. We think CoreWeave, if it's gonna make an outsized move, this profits if CoreWeave doesn't move at all. Like whatever strike we pick, that's max profit. If it moves violently, it's gonna not be as good for us. So if we think it's gonna move violently up, we want to do puts because we don't want to get assigned either. It has assignment risk, especially if they report on and you hold and blah blah blah. So you want to, if you think it's gonna rip up, possibly do the puts. If you think it's gonna rip down, possibly do the calls. So CoreWeave, I think, could rip up. So realistically, what I would actually do, like this is probably the trade I'm going to do. I don't know if it'll be this strike, but I'm going to short the weekly, it is the monthly expiration 130, okay? Collecting 1500, whatever. And then I'm going to come out here and I could buy the September. We got 110, okay? Or I could go out to October and then do the thing with the 95. I'm probably going to do, a lot of people go and just do this and this, but the problem is this crushes too. This one crushes too. And they all crush, but these really crush still as well. So I like to get, you want to avoid crushed in the back month, and I'll show you when we get into the analyzer. So I would probably go take something like this October, 130, buy. Okay, $800 debit. Let's go to the risk profile. The old risk profile, baby. This is the real important tool here. It always has been. So what's going on here? We'll go to today. Okay. So pretend that they report tomorrow, and this is our thing. Look at this is where our money is. This is why everyone says it's long vega, because it's long vega. It's like, oh, if vol goes up 10, you make $150, and you do on paper, but that's not how it works in real life, because term structure. And we're not going to go over all that. That's way over the scope of this video, but we're going to just talk about what actually happens. So first off, we have a pretty wide range here. 101 all the way up to 184 for break even. Our expected move on CoreWeave is 26 points plus or minus. Okay, so we're here, 26. What's that? 156 to there ish, like right here. 26, 104 ish, like right here. So if it stays within the expected move, theoretically we have profit. What actually happens? What actually happens here? So our max loss, first off, we always pay attention to loss as traders. We always pay attention to loss. And we know our max loss is the debit paid for options. Okay, 885 is max loss. Interesting. Okay. It really has to move, notice. It needs to go to like $60 or it needs to go to like 300, like 450, right? For you to actually realize the max loss. It's what's so nice about these earnings calendars is they are they're high risk on paper, low risk in reality. But what happens? What really happens is post earnings, this short strike, the weekly slash in this case the monthly, is going to crush bad. It's probably going to go down by almost 100 points. So this is going to go neg 100, more than likely. This might not crush it all. It might go up or it might go down slightly. Let's just say it goes down 10. Because it's not going to go down 100. It makes no sense. You're not going to have an 11 IV on the October. It doesn't make any sense. They don't crush equally with each other because that's not how this works. This is gonna crush violently this weekly. Soon as the earnings are released and the market knows where the stock's going, this vol is going to nothing. And these are all gonna come down as well, but it's gonna be somewhere between 68 and 190, whatever. It's gonna probably be maybe in the 80s or 90s if I had to guess. And that's what you have to do for this. You have to guess. So I'm going to guess that this front month will crush to 133. It might crush more. It might go neg 110. Maybe. I don't know. We'll just leave it at neg 100 for right now. And I'm going to guess that this one goes neg 15. Okay, there you go. There's the actual risk profile and what you're trying to capture. If the stock pins at the strike, you're going to make $327. Remember, we're going purple line here. If it goes to 160, which is outside the expected move, you're going to be up 125. You just follow the purple line around. As you can, and this way you can see that you have to have an obnoxiously large, like Sigma 6. I don't even know, like a obnoxiously large event for you to realize max loss on these trades. Which is not to say to get carried away and just go risking, whatever. But and so there's your P&L graph. And now also theta works in your favor if you hold this, throughout the week. That short put decays, and it decays a lot more than your what's it called? Your long put. That's, a month or two out. So theoretically, if you're super lucky and you play the delta in the directions, which is not really recommended, you're just trying to capture the vol crush, you can decay it to your max profit by expiration, theoretically. It's risky though, because the delta will fuck you up. If this shit's moving, it's gonna fuck you up good. So you got to be wary of that. Now this pink line, our vol crush is based on what we estimate. If we're way off here, this is also not going to be accurate. Like if this really crushes 150% and goes to 83 and this goes down to 25, then you'll make 553. If this doesn't move at all and this goes down 30, oops, getting carried away here, you're going to make 530. At the strike, right? It just depends. You need to model it. It's not an exact science. The quants are always trying to predict this shit and how the vol is going to do. It's very hard to predict, but generally speaking, this is going to normalize to a premium on these. Like I would say, if this is 150, that's 130. I could see this going down to personally, I could see it going down 100 points, like I had it originally. I could see this going down a large amount, maybe even 120. And I could see this also going down. Then this is going to hurt your profits, but it's still a net positive. Maybe this goes down more. Maybe this goes down 30, right? But it's still a net positive. So even though, and I'm going to wrap this video up because I'm trying to make these things quick. Even though this is long Vega, It is profiting from a drop in implied volatility because the front month drops much more extreme than the back month. And the front month's premium is crazy. The 130s, look at that premium. And then you're buying 70 days out. Look at that premium. I mean, that's really wide market too, by the way. You definitely want to watch the liquidity and the spreads on these, because that'll play a big factor in shit. You always want to watch your spreads. But conceptually, this is why the short front month decays a lot faster, a lot more rapidly than the long back month. So it is a long vega, long vol trade on paper. That's what ChatGPT will tell you. It's what the Reddit professionals will tell you. But it does not function like that in person. And if you don't believe me, then just sell one of these. Do the opposite and watch how you lose money. Right? Just do it. Okay, oh yeah, negative vega. Yeah, it's gonna vol crush. I'm gonna catch it, and you'll lose money unless the stock makes an outside move. If it rips either way, then you're on the opposite side of the trade. You're gonna make money. But I make a lot of money doing these consistently with very little risk. So yeah, and watch your assignment risk. If you're deep in the money and expiry is coming, and you can't afford to get assigned, maybe just close the trade. All right. So if you have any questions, put them in the comments, and yeah, I could talk more in depth about how to manage this, but I think this is good enough. So, all right, peace.